स्वागत है आपका हमारी इस खास पेशकश में। और आज हमारे साथ एक बहुत ही खास मेहमान जुड़े हैं। हमारे साथ जाने माने इन्वेस्टमेंट गुरु मार्क फेबर जुड़े हैं। उनसे हम बात करते हैं। मार्क, थैंक्स फॉर जॉइनिंग अस एट जी बिजनेस एंड इट्स अ प्लेजर हैविंग यू ऑन द शो। गुड टू सी यू, गुड टू सी यू स्माइलिंग. It seems that the doom is away, at least.
I beg your pardon?
So
what is the question?
Could you hear that, Mark?
Yes, what is the question?
No, my question was that, I mean, it's good to see you smiling. It seems that the doom is away for some time, at least.
Well, depends. I think the second half of the year will be more difficult for markets because we had really very strong markets in the first half. The S&P is up, the Nasdaq is up strongly in the US. As you know, India was a very strong performer, actually, the best performer in Asia in dollar terms. And also countries like Korea, which is surprising given the potential problems that could occur in North Korea. But anyway, markets have been very strong, and I think the second half will be more challenging.
But Mark, at this point, if you have to pinpoint any one factor which is causing maximum, I would say, uneasiness or maximum concern for you, which would that be? Is it slowing down of China? Is it the geopolitical tension that is going on? Is it the way Mr. Trump is approaching, the North Korea situation? I mean, which is your biggest worry at this point?
Well, usually I'm not terribly worried about markets, and I mean, for me, it doesn't really matter whether they go up strongly or they move sideways or they go down. But my concern is simply that if you look around the world, there is very little that is really good value. All financial markets, bonds are in the sky, especially in Europe, in Switzerland, Japan. You have negative bond yields, and on the 10 years, and equity valuations. The good companies are very expensive. So if you look at, say, the FANG stocks, Facebook, Amazon, Netflix, Google's, and related stocks, semiconductors, they're all in the sky after big moves since the lows in 2009. And the question is, can they alone continue to support the market, or will they go down? In other words, money flowing out of these few stocks, and the money then flows into maybe other groups. And so this is not a concern of mine, but it's an observation that valuations are very high. I look around Asia, I think Asian valuations are reasonable, but they're not cheap. They're nowhere as low as they were in 2009. They're nowhere as low as they were in 2003 or in 2001. So the markets have discounted a lot of good news, and we have to realize we are now more than 8 years into an economic expansion. The expansion began in June 2009, and the bull market started in March 2009. So we are, by historical standards, in a very old bull market.
That's true. So, in fact, a couple of days back, Mark, we spoke to Jim Rogers, and he sounded quite worried about the kind of run-up that across the globe had happened, and he almost predicted, 40-50% drop in the US markets valuation, and obviously which would be followed by other markets as well. Do you share that kind of pessimism? Do you feel that there is a possibility of US markets tanking by 40-50%?
Yes, but I'd like to point out, in my view, the Federal Reserve and other central banks, if they see markets drop even 10%, they will have second thoughts about increasing interest rates. 10% today would be 240 S&P points. If it dropped 20%, we're talking about 500 S&P points. That will scare central banks, and I think that there would be more money printing. Exactly what the additional money printing will do is not sure. Maybe it won't lift stocks to new highs, but at least it will temporarily support them. So yes, I think that reasonable valuation or low valuations would be 40 to 50% lower than they are now. And markets become overvalued and then they become undervalued. I think we're closer to overvaluation than undervaluation.
All right. Also, Mark, if you look at markets like India, you know, we are facing the similar sort of situation where the valuations are not really cheap. There is also, to some extent, leadership crisis in terms of who will lead the markets from here. And then obviously, you know, then we have reforms happening on the other hand. Like maybe, you know, the rollout of GST and the whole NPA battle that the Modi government is trying to wage against the non-performing assets in the banking system. Keeping all this in mind, do you suspect Indian markets also to follow the US way and see a massive correction in the near future or maybe this year?
Well, I mean, the Indian market is not closely correlated to international markets and depends very much on domestic liquidity in India and on economic performance in India. But obviously, if the S&P dropped 20%, I think that a lot of foreign investors would be selling Indian shares as well. And so everything is to some extent correlated to the S&P nowadays. The S&P drops 20 points. The next day, Asia tends to be weaker. Not all markets, but it has the tendency to be weaker. Europe tends to be weaker. And so when markets go down, they all go down with very, very few exceptions.
True.
When markets go up, most of the markets go up. It's like an advanced decline line among international markets.
That's true. Mark, last time when we spoke, you were more positive on Indian real estate than on Indian equities. Are you still in that similar set of mind?
Yes, I still think that in India, in the major cities, real estate is probably very expensive, pricey. But in the countryside, and as you know, there is an emerging class of people in India that can afford to travel, and they can afford to eventually have second homes. And so some resorts in India, there, in my view, there are still great property opportunities.
But now within the fiscal, because, you know, if you look at the Indian index or the Indian market, the highest weightage is actually assigned to the financial space and the banks. What is your view on the banks in India?
Well, I think that over time, more and more people will use banks and more people will use insurance companies. So these are two sectors that are longer term attractive. And I think the banks are not necessarily overvalued. I think some consumer stocks that sell at 50 times earnings are fully priced, but they've been selling at 50 times earnings for years now, and they grow, and so the stocks still continue to perform well. But I would not necessarily rush into Indian stocks at the present time. I think they are fully valued. They may become overvalued, and as you know, I was quite positive about India when the index was around 25,000. So here, at this level, I'm saying that it's not an undervaluation anymore, and that the economic performance hasn't been that great. Has been better than, say, in Western Europe and better than in the US, but it hasn't been that great.
Right. Coming back to US economy, Mark, I mean, what kind of mismatch do you observe between the real fundamental US economy and what is reflecting in the prices in the equity market in US?
Well, I think that the sentiment, both of equity investors and business sentiment, is quite optimistic, whereas the economic statistics that have been published recently, and you have to look at the economic statistics in every country with a grain of salt, because there are a lot of adjustments and distortions, and the government controls the statistical offices, so they can always publish what suits them. But in general, the reality is that wages aren't going up much, and that employment has picked up, but not in high-paying jobs, in low-paying jobs. And if you look at consumption is relatively weak. Automobile sales are weakening. They're not collapsing, but they're weakening. And the housing market is steady, but is not rising much. And so I think that if we analyze clearly the situation, at very best, long term, the US can grow at maybe 2% per annum at very best. I don't think they'll see much more growth than that. First of all, we have to understand we still have a huge credit bubble with us globally. Most of the recovery since 2009 has been financed by credit and by money printing and by fiscal expenditures. And so under these conditions, I don't see very strong economic growth.
Right. One last question to you, Mark. Now, like keeping the so-called correction or the drop in the US markets and the global markets in mind, which could be to the tune of 40-50%, and like you mentioned, it would test the nerves of Fed and other global central bankers. Can we expect in the second half of this year or maybe early next calendar year more liquidity sloshing around global markets and another round of quantitative easing going on?
Well, that is a good question. When I talk to investors around the globe, and I meet fairly sophisticated investors that look after family money and so forth, the reason you should not be overly bearish is that there is actually a lot of cash around. This bull market hasn't produced the euphoria that usually a bull market produces that goes up so much. There is some euphoria among some people, but in general, there is still quite a lot of cash on the sidelines. Say, you look at me, maybe 20% of my money is in cash. And if the markets dropped to a reasonable valuation, I would put that cash to work. And I visited the other day a very substantial family office, $13 billion. There are just two families that are there, the wealthy people in the US. They are 40% in cash. And another friend of mine, he's also a wealthy American, he's also 40% in cash. So I have to say, that may provide some cushion on the downside. But having said that, we also have huge debts. Some people have the cash and some people have the debts. And the people with credit, I think they're quite vulnerable. So I would essentially, if I were an investor, not overtrade and trade on credit, because otherwise you could get margin calls.
Absolutely. All right, Mark, thank you so much for joining us. Pleasure having you on the show as always.
Thank you.
Thank you so much.
Bye-bye.
Bye-bye.